Because the Fed are going to, cut their fund rate doesn't mean that mortgage rates are going to be influenced positively. Yeah, there might be call for maybe lowering these rates, hoping that they influence mortgage rates a little bit. I hope I'm wrong, but I'm not that confident that the Fed saying that they're going to have a fund rate is going to directly impact mortgage interest rates right away.
I'm Karl Kyler, your San Diego Realtor. We're back with Mortgage Talks with Matt.Kish of Movement Mortgage. Matt, thanks for joining us. Just a quick recap of the rates. It's kind of good news. We've had almost nothing happen in the markets really. So we had that big drop after that really, really bad labor report update. Rates came around 6.5 and they're kind of still sitting there. Is that accurate?
Well, they've ticked up about a quarter over these last 2 weeks. Some days are better than others, but yeah, we're right on par with where we were a couple weeks ago, more or less, which is good, right? Nothing came out of the Fed or out of Washington that made us, panic and rates shot up or down for that matter. So they stayed pretty static, kind of par for the course, like I said. But going forward, we're hoping for maybe policy change or see where the Fed's going. That way we could really kind of graph the trajectory of the new norm. Rates are right where they were a couple weeks ago, more or less, hovering right around 6.5%.
Yeah, it's been kind of boring news because there's been just such micro adjustments. But like I said, usually in the past where they've had this aggressive fall because of some report, President Trump or somewhere here or someone there says something, and then they shoot back up over a weekend. I think I remember in one of our earlier mortgage market updates with you, you mentioned that rates changed in the matter of 3 days, and 2 of those days was a weekend. It's just so crazy.
Yeah, it's been kind of the way we've had to tread the water the last few months, and we brought our life jackets with us, thank goodness. But it's hopefully again, policy is going to really track where we're going to head going forward, and hopefully if the Fed says they're going to cut, they're doing it because of policy and not because they're being influenced or pressured. Because if that is the case, if they just cut arbitrarily because somebody tells them to cut, then how much confidence do we have in anything going forward, right? So we got to really be careful and make sure these firewalls are instilled, making sure that things aren't politicized. But again, Jerome Powell is really good at steering that because he's a lawyer. So he's really careful with his words, and he's really good with that demeanor. But again, he's a lawyer, so he's not an economist. So again, a lot of people feel that he should be putting on his economist hat and not his lawyer hat. He's got one foot out the door. So we'll really see in these next 3 months going forward, September, October, November, before they take the break for the holidays, what they're going to do with these rates, and potentially what these cuts are going to do with rates. Again, because the Fed are going to cut their fund rate doesn't mean that mortgage rates are going to be influenced positively.
I'm glad that you bring up Fed Chair Jerome Powell. Let's go ahead and just go in that direction. He had a very, very big meeting recently at Jackson Hole. It was kind of a global event. And there he's kind of just stayed the course. We'll wait and see. But what's interesting, and I want to kind of highlight here, is the CME FedWatch tool, which is a metric that kind of measures or reports on a measurement of the chances of a Fed rate cut happening with each FOMC meeting. Prior to the Jackson Hole meeting, I think it was 81 or 82, around 80% chance that they'll cut at the next FOMC meeting, which is in about a month. Just in one day from what Fed Chair Jerome Powell said at the Jackson Hole event, it went up to 91% just from what he said at that meeting. So it's interesting. That was a big intro there. But let me ask you this. We have 3% GDP growth, which is equivalent to Q2 of last year. Our unemployment is sitting in the low fours. I think it was 4.2, maybe 4.3 if I haven't updated on it. And our inflation, it's actually been ticking up, I believe, on the last 2 reports on core. What reason does the Fed really have to cut rates? It seems like things are actually going well.
There's really not a whole lot, truthfully, to tell them to cut these rates unless they are kind of influenced, or also taking a look at the affordability of housing, right? Because rates are in a good place economically. 6.5% is kind of where you want them to live. But again, the affordability factor, prices of housing, prices of goods, and the interest rates combined are making it still tough for first-time home buyers, people to jump into a mortgage, right? So in that case, if you're looking at that kind of data, yeah, there might be call for maybe lowering these rates, hoping that they influence mortgage rates a little bit, saving you money on your credit cards, your home equity line of credit, your auto loan, stuff like that is really going to help. But if inflation's ticking up and groceries are more expensive, and if all things are still remaining equal, how is that going to ease the burden of getting into these expensive big homes? But at the same token, the economy, quote unquote, on paper is looking good. So why would they be influenced to do anything if the economy is, quote unquote, strong? So that's why we really got to get these job numbers tied down and locked, because there's still a lot of revisions going on. And the new head of the BLS said we may not have any reports. So how are we going to judge what's going on in the labor market? Hopefully ADP, paychecks, stuff of that nature will still report and give us a little shining of what's going on as far as unemployment. But unemployment's going up. People are staying on their unemployment benefits longer, and there's more people in the market for these benefits. So again, if unemployment's going up, that may be cause to lower these interest rates. If they're really looking at the data and seeing the squeeze that's still on people that are trying to purchase these homes, that may influence that. Or, like we just talked about, all you need is a day of good or bad news, and it'll sway the pendulum one way or the other.
Yeah, it's really interesting because we've had a couple of tariff negotiations get addressed and settled with some country partners, however you want to label it. And that hasn't had as much of an influence on the markets. It seems like the markets are really, really holding right now, kind of waiting to feel things out. Even with some recent earnings reports, I was really surprised that everything I see online is that the stock market is reporting new highs. And then we have these, bottom line, with the exception of not unemployment, but jobless claims, right? Jobless claims going up and people staying on. It seems like the BLS report on new job openings, we just can't dial in a number or a tracker that's effective and accurate enough that maybe we need to just look at GDP and unemployment claims. And if unemployment claims radically go up and then we start seeing earning reports for my thought is new construction. If those companies start going down, just because those have a ripple effect. So you think about construction. So you're buying land, you're developing land, you're building land, then you're selling land, and you're staging those properties, or not selling land, you're selling those properties, you're staging those properties in the process. All of that implies so many people, from the materials getting shipped there, and the materials actually just getting shipped in or brought together, and then you got the developers, and then you have the builders, the contractors. It seems like we can look at other metrics to determine the strength of the economy rather than trying to rely on these horrific, heavily revised BLS reports on the Bureau of Labor Statistic reports that are just so horribly misleading and end up causing mass volatility in the markets. And unfortunately, that stuff trickles down onto mortgage rates as well.
And like we talked about last week in these numbers and this data reporting, and everything needs to be a little more automized, right? We need to jump into the 21st century with the way that we collect this data, and this data then gets reported, and then we could create some kind of policy behind it. These surveys that we're using, these, calling the employers, hoping that these homeowners send in mailers, things of that nature, they got to go. We got to get with the times here. And the BLS really is one of those corporations that really needs to get with the times. All of these federal data collecting systems need to really step up what they do so that we could really get data real time, so we don't have the Jerome Powells who are always looking in the rear view, and then all of a sudden tariffs come up and they want to go stare in the windshield, right? So we have to make sure that the data is right, and we have to make sure that the data is relevant for what we're trying to do today, because what happened 8 months ago, it's great and we have the data for it, but how is it going to help us September, October, November of 2025? And that's kind of where people are at, because you can't get confidence when the report we looked at 2 months ago is revised 300,000 jobs less, right? How could we have any confidence with anything that's being reported when the data is old and we're seeing it revised in real time?
I agree wholeheartedly. So let's get to, lastly, what most people want to hear. Let's hear what your thoughts are, and then I'll share mine. Not that obviously I can't share yours, but you share yours and then I'll share mine. What do you think is going to happen for mortgage rates over the next 2 weeks? And do you think the Fed will cut rates at the next FOMC meeting, which is roughly in about a month? It's short of a month.
I think rates in the next 2 weeks will start to kind of trickle down because of the good news and what's come out of Jackson Hole and the markets, and I really think it'll start to trickle down. I'm still not very confident that a Fed fund cut is going to have a direct response in a positive way for mortgage interest rates. I'm just going off of what I've seen in recent history. Again, this is me looking in the rear view because we don't really have a lot of data to show otherwise. And last year it really bit us. And I would hate that. I hope I'm wrong, but I'm not that confident that the Fed saying that they're going to have a fund rate is going to directly impact mortgage interest rates right away. I think you're going to see it more in the S&P 500 in the stock market than you would as far as mortgage interest rates. Again, I hope I'm wrong, and I hope it really helps people out. I mean, shoot, it helps us out. But I would suggest, especially if we gain a little momentum in these 2 weeks and we see interest rates kind of coming down prior to, really lock them in and know that they're comfortable going forward regardless what happens with the Fed.
You make such a very, very good point there. So let's just recap on that for those who are going to watch this. Last year, about the same time, the Fed did 2 cuts back to back, and both times mortgage rates went up. Now, I'm kind of in the same boat as you. I don't study rates as much as you, so I'm gonna slightly deviate out of my lane, but take it for what it's worth. I'm hoping rates will stay over the next 2 weeks, mortgage rates. I am hoping that whatever the Feds do in September, I don't see why they need to drop rates right now, cut the Fed funds rate. I think that the economy shows a lot of strength. We don't need to spur spending because spending already looks kind of strong economically. Like we already look like we're still doing well. But what I am hoping is that mortgage rates don't go to 6. I think we need to stick it out where we're at right now, push affordability, allow the jobs markets to actually grow on their own incomes and such like that. Right now, we need to keep home prices where they are, or at most with like very, very little growth. And what I'm seeing on my side, actually, we're both seeing this because we're in these conversations every day. I'm blowing you up with calls. How do I do this? And how do these numbers map out? But right now I'm seeing way more, not ubiquitous. It's not on every transaction, but way more negotiations of credits to buyers. And I'm even seeing, it used to be 1-0 buy downs, 2-1 buy downs. Now it's like 2-1 buy downs, almost on the table oh my gosh, probably more than half the cases. And I'm even having the listing agents are talking to me about, have you talked to your lender about what a 3-2-1 buy down would be? They're already trying to offer credits to that size. That is an opportunity to, I don't want to say solve the affordability, right? I think only time will do that. But with these rate buy downs, if we can keep mortgage rates where they are and just kind of get these rate buy downs in place that give the buyers 2 to 3 years, not to qualify them at that discount rate, because that's not how they qualify. Let's be clear there. But just to give them breathing room to acclimate and settle into home ownership over the next 2 to 3 years, I think that will put our housing market overall in a much, much better place. And it'll allow nationally all the markets to kind of like settle out a little bit and kind of get on the same path of a similar trend. Like the Northeast is still showing ridiculous positive growth. Then you got the South and parts of the Midwest that are showing negative. And then you have like the West Coast, which is showing pretty flat, like very neutral market tendencies, where it's like we're positive one month, we're negative the next, positive, negative. So it's kind of flat. So that's my long-winded hopes and expectations there.
Yeah, and again, affordability and comfortability, that's my job, right? Like that is my lane. I got to make sure you can afford it, but more importantly, I got to make sure you're comfortable paying 360 payments at whatever the payment is, right? And getting into these temporary buy downs is great. But again, if we're dealing with, like, let's just hypothetically say we're dealing with first-time home buyers. Sometimes first-time home buyers don't have enough skin in the game, enough down payment to recoup all of these credits that are possibly out there, right? So being in the business, the loan officer and the real estate agent, we got to make sure if they're only putting 5% down, we might not be able to get enough credit back to get the 3-2-1 buy. So we got to make sure that we're all, if we're going to be doing these buy downs, we all make sure that we have all the information at hand, because we don't want to leave any money on the table either. So the affordability. If we could get these buy downs, absolutely. Again, you got to qualify at the highest rate, the qualified rate. But if we get a 2-1, a 3-2-1, a 1-0, if we could get you more comfortable with the house, of course we're going to do that. And we're seeing these credits because, of course, these houses are sitting on the market a little longer, and some of these folks need to go. They need to move. So a lot of them are doing a little more than the usual and the norms out there to make sure that the buyers are happy and are staying in the game, and that they could get a little bit of equity before they leave town.
Yeah, in most cases, I'm seeing the buy down options on the attached market, so condos, townhomes, apartments, and such. And then a lot of stuff over 1.6 so far. That's been my experience. And this brings what you just said brings a very, very point to the table. There's a lot of talk out there. I'm one of those individuals that talk about this, okay? So I'm out there doing this. There's a lot of talk about buy downs and such, but there are a lot of variables that are involved in what a buyer can qualify for with certain buy downs depending on the situation. So if you're thinking about buying, if you want to explore your options, okay, this is essentially the close right here and the call to action, okay? Just call Kish. Just call him. His contact info is in the description below. Give him a call and say, hey, my name's so-and-so. I watch you guys on YouTube. I'd like to have a conversation and explore my options. And he'll walk you through everything. You don't even sign anything. He'll walk you through your financials. He'll look at the opportunities afforded to you and he'll say, hey, here are your options. Here's some other ones if you want to explore this as well, if you want to go another route, okay? If you have any other thoughts, questions, concerns, don't hesitate to reach out. Kish, do you have any closing thoughts or contributions to the audience?
Yeah, just use me as your human chat GPT for home loans, right? Everybody's chat GPT and everybody's putting all the questions in. You got questions like that about mortgages and home loans? Feel free to give me a shout.
Yes, I agree. I would say that ChatGPT can't do two things. One, it can never tell me what my wife actually means when she's talking to me. And two, it's not going to provide the same level of service that Kish would when it comes to exploring your scenarios when it comes to home loans. So thanks again, Kish. As always, I'm Karl Kyler, your San Diego Realtor. We'll see you in the next video.